Today we're going to be talking about the limited company. The limited company is an invention of the capitalist system that has probably brought more wealth to people of lower income than any alternative economic system. Why is that the case? Well, we shall see from the it should become clear from our definition of the limited company. Here are the learning outcomes. You can look at those. Definition of a limited company is that it is a legal person. Okay, what does that mean? It means that it can sue and be sued. It is separate from the owners. It can enter into contracts in its own name. It's responsible, as it says there, for its own actions, finances, liabilities, and assets. So it's just like a person, only it doesn't actually exist as a person. Now, the owners of the company, of a limited company, they set it up and they are the owners of this. And the key issue is that they are protected by limited liability, which means that if a company runs up huge debts and becomes bankrupt, that they're only responsible for the value of their investment or any guarantee they've made to the company. So they're not they're not liable for the whole debt. So a company might run up a huge debt, much more than the person contributed, and that person is protected by limited liability. So that enables somebody who isn't fantastically wealthy to start up a business and not be afraid that if the business should run into difficulties, that they're not going to be faced with an impossible bill to pay. So you can see that that then opens up business opportunities for people who do not have great wealth. And so it is a marvelous vehicle for social mobility. Right, well, a limited company must be registered at Companies House. You can Google that, and you can download the you can download the accounts of companies and other documents that are filed by the limited company in Companies House. So it's really quite transparent. You can see how well the company is doing, and we did that when we looked at Evans the Fish Shop. We looked at their annual accounts and, as in an earlier lecture, to analyze their balance sheet. Right, and then finally, for a company can, as it says there, the same person can be the owner and the director, can be the shareholder and the director of the company. So you can set up a company, as it says there, by yourself, with other people, set it up as a limited company, and you'll only be liable for the amount you've contributed to that company. It might not be a great deal, and also any guarantees that you've made. And you can then operate as a company, and you will pay company tax and so on. So that is what is meant by a limited company, and we're going to be talking about the role of accounting for this legal entity. Some of the features here that I've brought up in various ways. Legal nature, we talked about that. Perpetual life, it is an unlimited life. It can end its life either by becoming bankrupt or being wound up, and the reason for that may be bankruptcy, or it may be that the company just the owner just wants to end the activity. But apart from that, it can be a perpetual life. It can be handed on down through the generations, and you do see this. There are some companies which are well over 100 years old. Limited liability, we've talked about that. Legal safeguards, there are many Companies Acts, all of which are designed to safeguard the company and to safeguard the society and to ensure the smooth running of a company. Two types of company: public limited company, that's for large companies; private limited company are for small companies. Who dominates the market? Large companies. In the main, it was some years ago thought that small companies might be the future. That's not the case. Multinational companies in particular, large national companies, they dominate our markets. Now, companies raise money, and for a small company that would be kind of like you setting up a company. You would be the main investor, though you might have other members of your family chipping in and taking 10% or whatever. So a limited company can raise money like that from whoever. If it's a larger company, then it goes to the stock market or the stock exchange. And that's a public arena where there are two types of market. One is the primary market. That is where money is raised, where the company issues a prospectus. Often it's a limited company becoming a public limited company wanting to raise money. It will issue a prospectus saying what its future is, what its plans are to do with the money it raises. And it circulates the prospectus to investing institutions, insurance companies, pension funds, and the like, as well as the general public. And it invites people to buy a share in the amount they want to raise. The share is, as it says, it's a share of the amount. So they might raise £1 million in £1 shares or something like that. That's the primary market, and the company benefits from that. Then there's the secondary market, and this is quite simply the second-hand market for shares. So the original investors don't have to invest forever, because a share does not have a redemption date. There's no repayment date. It's got no such date, so it's an infinite time. But it's not infinite for the investors, because the investors can sell it to another investor in the marketplace, in the secondary market. And that's the one that dominates the stock market. So when they talk about share prices falling or going up, they're talking about the share price on the secondary market, the price at which shares are being exchanged between investors. When they talk about the stock market index, they're talking about the weighted average price of shares. And that is an indicator of investor confidence. If the index goes up, it means that the investors are confident about the future, and they see that the shares they're buying have a good prospect of making high profits in the future. So the secondary market is where all the focus is. But from the company point of view, the primary market is the one they are interested in, because, as you can see in the diagram, the company does not benefit through movements in price on the secondary market. They only benefit from the primary market, the first issue. And it's, much the same with any products. Car makers, the primary market is selling new cars, just like new shares, if you like. The secondary market, the second-hand market, a car maker, VW, Toyota and the like, they don't benefit directly from the second-hand car market. But nevertheless, the secondary market does influence the primary market, because if the company wants to raise more money, whether it does so successfully will depend on the performance of its existing shares in the secondary market. So if this tells the company what investors think about them, and if their shares are going up, it means that if they want to raise more money, it's likely that they would be successful. This is some formalization of what we've just been saying, so we can go through it pretty quickly. Maturity transformation, short-term lenders to long-term borrowers. Long-term borrowers are the company, short-term lenders are the investors, because they're short-term because they can sell the shares to investors at any time, and sometimes people in the investment making the original investment will sell the shares on the secondary market on the first day of trading, so their holding of shares may be just a matter of weeks. So the lenders or investors can be short-term, some will be longer-term. Long-term borrowers, well, we've said that shares don't have a redemption date, so it is long-term borrowing. So that's very useful. If BP couldn't raise shares through the stock market, or if there wasn't such a thing as a stock market, it would have to go round to people and say, well, do you want to lend money to me, only I'm never going to repay you. I will pay you some dividends every year, but I'm never going to pay the amount you lend me. That wouldn't sound too attractive. The stock market makes it attractive, so that's a very important issue. Risk transformation, I think, is relatively straightforward. A share is a small part of the amount that they want to lend, to borrow rather. So from the investor's point of view, it need only be a small risk, and that risk, that small risk enables the investor to take a small risk for investments that in total are much higher risk. It raises large funds. We should make the point, obviously, a company wants to borrow, may well borrow from the bank, but the bank will limit how much it is willing to lend, and if a company wants to go beyond that limit, then well, it would initially be a syndication of banks, but after that it would have to go to the stock market. So to borrow large amounts of money is the stock market. And then finally, the stock market performs the service of valuing companies. A company is a bunch of projects, and the stock market price tells you what society, if you like, thinks of the value of those projects. So it helps to filter, if you like, projects which are successful, their share price goes up, from projects which are not successful, their share price goes down. So it's important that the investors in the secondary market are well informed, so that their valuation is based on good information. That good information are the accounts. That provides information to the investor as to the benefit, as to the value of the company. There are some rules underlying disclosure. There's a framework of rules. If we go to a set of accounts, I've got Rolls-Royce here, Rolls-Royce annual report. Here it is, annual report. There's a framework of rules which govern the profit and loss account and balance sheet that is reported in this document. We've talked about this before, but as you can see here, a lot of numbers are being quoted, all of them from the accounts, and the financial statements, group financial statements. These form the bulk of the report, going from 115 to 167, so a good 50 plus pages of accounts, which should satisfy any accountant. That the accounts are prepared in accordance with the framework of rules, and unfortunately there are many frameworks, but the stock market the London Stock Exchange will require certain rules to be conformed with before the shares can be quoted, and it's important that the external auditors, these are independent partnerships that check the accounts, and they are appointed by the shareholders to check the accounts produced by the directors. The independent auditors report, as you can see here, it says group financial statements being properly prepared in accordance with the international financial reporting standards as adopted by the European Union. And there's some other reporting standards that it talks about. Financial statements are being prepared in accordance with the requirements of the Companies Act, right? That's the government requirements on companies as regards group financial statements, Article 4 of the IAS, International Accounting Standards, and so on. So, as you can see, it's quite a lengthy report, and it will talk about some of the valuation problems and issues that it encountered when checking the accounts. Recoverability of intangible assets like goodwill, how much is it really worth, and so some comment on that. Don't know what the bribery and corruption is, but anyway. So quite a long report prepared, and it's all about the accountability, disclosure rules, and the general concept that the account should be a fair view of the value and the profits of the company over the past, the profits of the company over the past year and its value as at the accounting date. Now, we made brief mention of the Companies Acts, and the UK government is concerned about governance, how companies are run, and it will have a number of requirements. Read through these. I think they're all reasonably self-explanatory, so you will get the idea that this is kind of a list of what constitutes fair management with proper deliberation, proper communication, and proper information. The board should formally and rigorously examine its own performance each year. Right, so reflection and discussion. Take precedence. Right, well, we've got some comments on the types of capital. This is going into some detail, but only sort of skimming the surface of a whole area of rather pernickety differentiation. So we'll start with shares. And there are many types of shares. Shares can have varying voting rights, and they have also varying claims on profits. We said that the profit is the amount due to shareholders. Well, the amount the shareholders can be of different types. So ordinary shares are the basic, that's the basic type of shares. And if you just have ordinary shares, then they're entitled to all the profit that the company makes. They may leave it in the company, so it's retained profit, or they may take it out of the company as dividends. However, if the company issues preference shares, then these are shares often with no voting rights or reduced voting rights, dependent on the conditions of the preference share, and these will take, as it were, first cut. So the preference shares might be guaranteed 3% when profits are made. So that 3% might take up all the profit of the company, in which case the ordinary shareholders wouldn't get anything. On the other hand, if the company makes higher level of profits, then the preference shareholders would just get their 3%, and the ordinary shareholders might get all the rest, which might amount to an 8% return. So it's a different share out of the profit. Now, shares have something called a nominal value. We've said that on the balance sheet we've got equity, which is the amount that originally contributed plus the reserves, retained profits and things like that. So it has a balance sheet valuation based on transactions, and now the shares themselves have something called a nominal value, and that nominal value is just there so that it appears on the balance sheet. So to take a desperately simple example, a company might have say 2 shares at a nominal value of £1 each. So it would have on the balance sheet shares under equity, shares 2 at £1, £2, and you may think, oh, that's not worth a lot, but it may have raised much more than that, and that would go into something called a share premium account, and profits may be such that actually on the balance sheet the total value owed to the shareholders is much more than £2. Keeping the numbers relatively small, it might be £10 or £20, but its nominal value will be £2. So it's just a way of measuring the number of shares and making them appear on the balance sheet. From balance sheet purposes, it's the total amount owed to equity is going to be more than the nominal value in most cases. So it's just a way it's a unit of measurement of the shares, but not the value of the shares. And we need to make the point also that the value of the shares on the balance sheet is different from the value of the shares when exchanged in the stock market. So this value in the secondary market is looking forwards to what the company can earn in the future in the opinion of the investors. The accounts, the balance sheet and the profit and loss account are essentially looking backwards, looking at what the value of its assets are at the moment and what profit it made over the previous year. So unsurprisingly, those two valuations differ. So the equity value on the balance sheet will not be the same as the value of the shares that the shareholder owns. The value of the shares as traded in the secondary market, and the investors are interested in the stock market value of the shares rather than the actual value on the balance sheet. Companies can mess about with these shares, so it might be £100 £1 shares that they decide to have a share split, so 250 pence shares. Your voting rights, your share of the profits doesn't change. It's just that it's in smaller units. It's a bit, it makes the price of one share less, but your total value, the total value of your investment remains the same. So instead of having 10 £1 shares, you have 20 50 pence shares, but the proportion of profits that you get will remain the same. And it can go the other way. There might be lots of say 100 1p shares that it decides to consolidate into 2 50 pence shares, and again the voting rights will remain the same. Voting rights and share of profit. companies may simply issue shares to investors without asking for any money, and that will kind of dilute the share price, and this is done, as you can see there, to lower the market share. It might make people feel good having more shares. It won't make them any wealthier. It won't increase their control of the company. So these three factors, and it's thought it might increase lender confidence having more shares, because if it means that the price will go down, it must mean that the business is confident that its share price in the future will increase. As we've been saying, the sources of long-term finance: share issue, that is for the biggest amounts; retained profits, profits not distributed to shareholders but kept by the company for investment. It is owed to the shareholders. It is part of the shareholders' equity valuation on the balance sheet. That is another major source of long-term finance. And then it can also borrow long-term from the market in the form of bonds, which is a non-voting form of borrowing with a fixed interest and repayment schedule. So that's called a bond, and a company may issue bonds. And also it may borrow from banks for medium to long term, and it will also engage in some short-term borrowing, but that's not long-term finance. So it can also borrow from banks for reasonably long periods. What is long-term? Well, 5 years and above. So the share capital is made up of our nominal value, which I explained at length earlier on. Capital reserves, these are profits that have not been distributed. Oh, I'm sorry, they are reserves of a non-profit making nature that are owed to the shareholders, and might be something such as share premium account, which we won't go into. And then revenue reserves, these are undistributed profits. Layout of income for a limited company. Well, we looked at this more or less when looking at the income statement in the previous lecture, so that is really a reminder of that. And here's an example of an income statement with some numbers in it. Have a look at that. And then the balance sheet, and again we've looked at balance sheet. So these are the financial statements that are reported to the shareholders. And here we have an explanation of equity. Ordinary shares 50p each, 200 million. Share premium account, that's sometimes in the initial raising of money it raised 230 million, and it may have issued 400 million shares at 50p each, and they went for a bit more than that, and so that accounts for that share premium account, which is a capital reserve. Other reserves, odds and sods, and then retained earnings. And then we have the non-current liabilities. So this is the total financing of the company, if you like. Borrowings, current liabilities, creditors, trade payables, and taxation. Here we have an income statement similar to the previous one with De Silva. It's just another company here. So have a look at that. But I would urge you, as I have done in previous sessions, to have a look at a real annual report. You won't understand all the figures, but they are actually there to be understood. But for some parts of it you'll need specialist knowledge, but you should be be able to understand the general outline, and the balance sheet and profit and loss account will not be so very different from these simplified examples. And it's quite remarkable that these very large, hugely complicated businesses can summarize their performance in such a simple way. There is a statement of equity changes is quite a significant addition to previous formats for reports. And what have we got here? Change in the fair value of various re-evaluations, remeasurement of defined benefit pension schemes. So, not sure what's happening there, but it is a very big figure. I would have thought that would be a deduction from retained earnings. Tax adjustments. Also, this is going into the details, but it's accounting for the changes in the ownership, total comprehensive income, profit for the year. These are the main ones that we've been looking at, and then these sort of lesser items that can be quite large in themselves. We talked about this. We had a quick look at the Rolls-Royce accounts, external accounting rules, international IFRS as they're called, reporting standards, company law and stock exchange rules imposed by the Financial Conduct Authority. I think they keep changing their name, but it's just the government essentially. Relationship between shareholders, auditors and directors. We have kind of implied this. The shareholders elect the directors at every year. Well, a director usually is in post for 3 years and is re-elected every 3 years. The directors every year report the accounts with the annual report that we looked at, and the auditors are elected by the shareholders, and the auditors make out a report to the shareholders, and we looked at that earlier. They do that on the basis of a review of the reports prepared by the directors. So is this a group of 3 at the top of every company? The report includes a management commentary, director's report and a strategic report. Here it is for Rolls-Royce, director's report, all these items. Strategic report will be included, the elements will be included in this section here. Okay, so quite a comprehensive statement for public limited companies. For limited companies, it's going to be virtually non-existent, just very, very much briefer. But we don't really want to be asking Evans the fish shop for a strategic report. If you go through the director's report, you'll find all this information. So have a look through this. And the main features of the strategic report. So it is a good idea to have a look at a set of accounts. You just have to Google, say, Tesco annual report, and it's a good idea to add PDF, and that should take you straight to a downloadable report. Or you may have to fiddle about these days. Unfortunately, some of these companies tend to hide the basic report, but it will be there somewhere. And we'll have comment on these various factors. They have to be reasonably honest, but this area of reporting is far less subjective, and you make a big mistake if you are assessing a company if you start to buy into their comments too much. You have to be very skeptical. The accounts are controlled by the auditor. The bias on the director's report and the strategic report is not really auditable, though clearly they mustn't make statements that are completely out of line with the existing performance of the company, and the auditors will no doubt have a look over that to see that the figures are not being abused. This is the position as regards Tesco's, and I've been saying Tesco's or Rolls-Royce are two good examples. Okay, so that's it for this session. We've been looking at limited companies. We've been looking at their position in the stock market. We've been looking at the governance issues that surround limited companies, and also the role of the accounts in the overall report that companies have to make. Okay, thank you.